Economic crisis in China is about to worsen significantly, housing collapse explained. The slowdown in China's economy is a result of the country's adjustment to the punitive zero-COVID plan and declining global demand. The world's second-largest economy's contraction raises the likelihood of a global recession. Official growth results for the quarter from July to September are due soon. Beijing's target of 5.5% annual growth is already out of reach, despite the fact that officials have downplayed the significance of meeting the objective. The quarter from April to June saw China just avert decline. Some economists predict no growth for the upcoming year. So is economic crisis in China about to worsen significantly? The lockdown halted both life and economic activity in Shanghai, as it had in Wuhan 2 years earlier. Expressways, container ports, and other distribution infrastructure went offline across a large area, paralyzing the Changjiang Delta, the heart of China's economy. Shanghai, the world's largest container port, serves as a sort of main artery connecting the Chinese economy to the global economy, so the effects of the port shutdown spread down the supply chain to the global economy. In Japan, disruptions in shipments of Chinese parts forced manufacturers of automobiles, appliances, and electronic devices to reduce operating hours or seek alternative suppliers. In response to this state of affairs, the Chinese government implemented a slew of policies in April aimed at easing the flow of goods and strengthening the supply chain, including a whitelist of 666 companies whose products, which include automobiles, medical supplies, electronics, and everyday necessities, would receive preferential treatment. As a result, factory output and shipping volumes have been steadily increasing since May. However, the damage caused by the lockdown was too severe to be easily repaired. The Chinese Statistics Bureau announced on July 17th that GDP for the April-June 2022 quarter increased by 0.4% over the same period the previous year, a significant slowdown from the 4.8% growth recorded in the January-March quarter. The slowdown affected the entire East China region, which is the nation's economic heart. Shanghai suffered the most, falling 13.7% year-on-year, while Jiangsu and Zhejiang provinces experienced negative 1.1% and 0.1% growth, respectively. In fact, all of China's major cities suffered significant damage. While not as severe as the Shanghai lockdowns, Beijing's capital also implemented stringent COVID-19 regulations, causing its economy to contract by 2.9% year-on-year. However, China's industrial output increased 4.2% from a year earlier in August, bettering the 3.8% growth in July, according to official data released on Friday. This suggests the economic recovery is continuing to gain traction. In an analyst poll conducted by Reuters, the data exceeded forecasts for a 3.8% increase. Instead of the 3.5% increase and 2.7% growth in July that analysts had predicted, retail sales increased by 5.4%. Compared to the same period last year, fixed asset investment increased by 5.8% in the first 8 months of this year, above experts' estimates of 5.5% increase and growth of 5.7% from January to July. In response to outrage over a financial scandal that revealed the frailty of the nation's banking system, unidentified security personnel in China's central Henan province violently dispersed a large-scale rare demonstration. According to some estimates, more than 1,000 protesters gathered in front of the People's Bank of China's Zhengzhou branch on Sunday in an effort to get back frozen savings stored in rural banks. Others demanded that China's leader Li Keqiang personally step in. Some demonstrators brandished placards that said, "Henan banks, give me my money back." 4 banks in Henan had a bank run in April as a result of a significant number of depositors trying to withdraw their cash. As a result, they started organizing protests to demand their money back. The banking and insurance regulator for the province of Henan declared late on Sunday that it was accelerating efforts to address the local financial crisis and defend the legal rights and interests of the broader public. To have a better understanding, let us have a look on what is the real estate crash. Property values typically fluctuate in cycles. When average home prices exceed their intrinsic value, the market cools and they reach a peak or bubble. The price fall may occur gradually or suddenly, depending on the degree of cooling. When homeowners take on larger mortgages than they can afford due to excessive lending, whether as a result of predatory lending practices or a shift in their economic situation, housing bubbles can develop. These homeowners may be compelled to sell if real estate values fall, which would increase the number of available homes. In 2011, home prices in Beijing and Shenzhen increased 140%. Residential property investment in China tripled from 2% in 2000 to 6% in 2011. the same level as the US housing market before it crashed in 2007. Average prices in both residential and commercial real estate in China tripled between 2005 and a peak in 2009. Demand for homes in China increased due to low interest rates, easy access to funding for real estate and construction projects, restrictions on Chinese investors' access to international assets, and cultural norms that support home ownership. As property developers face a new financial crisis in 2022, the slow-motion collapse of Evergrande, whose lenders appointed a receiver last month to seize its Hong Kong headquarters, is what started the country's most recent housing market disaster. Chinese banks have begun obtaining funds from the bond markets for their reserves by 30% more than they did last year in anticipation of significant losses on loans. Due to their large holdings of corporate bonds, US and European businesses were significantly exposed to Evergrande, raising the potential of issues extending outside of China. 1/5 of China's GDP is attributable to the real estate industry. The global economy as well as China's domestic growth would be affected by a crash in the housing market in China. In contrast to July's 0.9% year-over-year decline, the average price of a new home dropped by 1.3% in August across 70 major Chinese cities. In 50 of the 70 cities, prices had decreased. It was the fastest dip since August 2015 and the fourth month in a row of decline. After being stable in June and July, new home prices dropped by 0.3%, the most since November 2021, as some home buyers refused to pay their mortgages on incomplete projects that they had already pre-sold. Due to restrictions on population mobility, decreased economic activity, a decline in real estate sales, and a slowdown in construction activities, China's government implemented a zero-COVID policy. The fact that Country Garden, the country's largest developer ahead of Evergrande, stated that its profits fell by 96% in the first half of 2022 is an indication of the severity of the real estate crisis in China. The People's Bank of China and the Ministry of Housing and Urban Rural Development jointly hosted a symposium on August 20th, 2020 with Country Garden, Evergrande Group, and Vanke, three of the largest real estate developers in China, and proposed implementing a policy to oversee and manage loan regulations for the real estate sector. According to the policy, the three red lines are three specifications for a developer's balance sheet that are part of this regulation. A minimum asset-to-liability ratio of 70% is required. The ratio of net debt to equity must be below 100%. Cash to short-term borrowings ratio of less than 1 is required. The policy assigns 4 colors to real estate developers, with each color representing the number of red lines crossed. Each crossed line is accompanied by annual growth restrictions on interest-bearing liabilities. Green indicates that a company meets all 3 of the 3 red lines, and the liability growth rate cannot exceed 15%. Yellow indicates that one line has been crossed and the liability growth rate cannot exceed 10%. The color orange indicates that 2 lines have been crossed and the liability growth rate cannot exceed 5%. Red indicates that all lines have been crossed and that the liability growth rate cannot increase at all. The government mandated that all 3 real estate developers present at the symposium meet their debt reduction goals by June 30th, 2023. The overarching goal is to reduce leverage, increase liquidity, and mitigate financial risks associated with high-leverage debt refinancing strategies. So far, increased regulatory pressure has triggered some intriguing trends in China's real estate sector. Due to increased financial pressures and constraints on smaller real estate companies, the number of mergers and acquisitions has increased. Due to a lack of liquidity and competitiveness, as well as low operational turnover, small and medium-sized developers are struggling or defaulting on loan repayments. Land acquisition rates are slowing as developers shift their focus to rebalancing their balance sheets. Real estate developers' IPOs on the Hong Kong Stock Exchange are being delayed, and applicants are submitting multiple filings because high debt levels indicate high risk and as a result do not adhere to listing standards. Thousands of would-be homeowners in China announced on social media in mid-July that they would refuse to pay their mortgages. The homes in question were purchased using a prepay model, which allows buyers to purchase apartments that are unfinished or have not yet broken ground when the initial deposits are paid. Developers guarantee delivery of the finished homes within a specific time frame in exchange for the prepayments. However, many have fallen short due to overly ambitious construction plans, exorbitant debt, and stricter regulatory environments intended to deliver the business. Because of this, some families had to wait years before they could move in and start making mortgage payments. More and more developers might not be able to deliver on pre-sold homes if the housing crisis worsens, potentially disappointing even more home buyers. The so-called mortgage boycott has extended to over 100 locations and poses a threat to further shake the increasingly dependent on mortgages real estate sector. The government has taken action in response to the problem to allay the worries of borrowers, including asking banks to bolster funding for incomplete housing projects and considering a mortgage freeze for those borrowers. What do you think? Is this the right step? Will China be able to get out of these crises?